Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right, we're back. Hey, Paul, what's going on, man?
How are you?
New? I'm good. Just another December week, man. Got the house decorations up. Everything's feeling very Christmas holiday spirit around here.
Yeah, no, that's great. I love this time of year. Today's my daughter's birthday. It's Carmela's
cool.
birthday, so have a teenager in the house.
All right. Yeah,
So
have fun
shout
with
out
that.
to her. She's wonderful and becoming a young lady, and so.
Cool.
But yeah, time flies.
Yeah, it does. Yeah, you taking time off this month?
Yeah, we're going to Italy for Christmas.
Ooh. What part?
So I'm all
what part is
approved.
your family from?
Well, it depends. Half from Sicily, I suppose, and the other half from the mainland Italy. I think my grandmother's father, he actually grew up, he was born in Brazil, but I think they were more northern Italians because they're fairly fair-skinned.
Yeah.
Like my grandmother's pale.
No,
my mom is-
Sicilians, mainlanders don't really consider them Italians. They just consider them Sicilians, right?
You know, we'll
They're-
find out.
Yeah. Yeah. I remember I went to pilot training with one of the guys was, I believe, from Sicily.
Yeah.
And the other Italians in my class were like, oh, yeah, he's got mobster ties or something like that.
Yeah. Oh, yeah. Yeah, I won't speak to that, but yeah, your name ends in a vowel, and then, it's. I can remember my grandfather telling me about it when he was a child in like the 20s and 30s that, people were packing heat at the house, playing pinochle or whatever they were doing.
Yeah. Yeah. Well, cool, man. That'll be fun. Wait, you're going to be there over Christmas?
Mm-hmm.
Oh, really? Wow.
Yeah, we have friends that are stationed over there, some really
Yeah.
good old Army friends of ours, and Tammy's known our friend Christina for over 20 years. So
Cool.
yeah, so looking forward to it.
All right. Well, have fun. So we better get ahead on a couple episodes before you leave the country.
Right.
So we don't have to do this in the middle of the night your time.
You could do it while I'm in Rome.
When in Rome.
When in Rome.
It doesn't really make sense. Go on. All right. Well, hey, so today, let's talk about the noise. We've talked about this before. It's been a long time, but we've got more listeners now, and probably not everybody started at the beginning. And frankly, man, when you start, maybe people found us by just doing research, right?
They do.
found our podcast on YouTube or
No doubt.
just searching infinite banking on their phone. On a podcast platform. So, but you're going to come across a lot of other stuff, especially every year. There's more and more stuff out there because this becomes more and more popular. It's almost to the point where I don't hear the question as often as I used to of why hasn't everybody heard of this? Because people are really hearing about it now.
Yes.
Unfortunately, they're hearing a lot of noise, as we refer to it in the business, where you can go down a rabbit hole, but man, you could get lost real quick
Yes.
if you're not looking at the right sources. So what are the different types of noise out there that we got?
Well, in the early days, I suppose we kind of always sometimes came across that people maybe found us through whatever website. Is this a scam? And some of my earlier clients, that you had the scam discussion.
Yeah.
And I'm like, well, what part? Like paying whole life insurance premium, which has a cash value, which is a very old, tried and true product. There's mutual companies that are over 100 years old that have paid a dividend every single year. Which part? The fact that you can, leverage cash value, which is the, present value of the death benefit. So they never really, then once, you ask a few, follow-up questions with them, they didn't really have a good answer of the you look at your life insurance contract, folks. Look at the guaranteed side. That's literally what it means. It's guaranteed by the contract. The non-guaranteed side assumes the current company's current dividend experience. So once you put it in perspective, and I think that's kind of like the product versus process issue.
Right. Yeah,
They
exactly.
think of IBC as like a product. It's not. It's a concept. It's like an abstract. It's something you can do, and you can do it not only with dividend paying whole life, but you could do it with CDs. You could do it. You can bank with anything. You could do it with your savings account. And Nelson demonstrates that in the book. He just says that, hey, dividend paying whole life structured for this concept is the best way to implement or to practice the infinite banking concept. So anyway, but we don't get that a lot. The scam thing. I mean, and frankly, folks, that's not something that we're really going to entertain. Obviously, you guys, by listening, you know that Dave and I own dividend paying a whole life, and we show people that go through our process our personal contracts. We pay a tremendous amount of life insurance premium every year. Now, we either do that because we're practicing, and which we are, or we're dumb.
Yeah. Or maybe I'm just scamming myself.
I'm just scamming. Yeah, I love to just rip
It's
myself
such
off.
self-loathing that I just
Right.
rip myself off.
And
Yeah.
obviously, that's not a serious discussion, I guess, is what I'm saying, Dave.
Yeah,
It's just really not.
Like you said, if you're listening to this, you're probably not somebody who thinks it's a scam anyway. So we won't spend the time debunking all of those poorly informed
Yeah.
myths out there.
When it comes to this product and the process of IBC, there's those of us who know, and those of you who now know, and then there's everybody else.
Yeah.
So
So really, there's two categories that we want to focus on. One, if you've done any research, you'll see there's a movement that IUL, Index Universal Life, is the only way to do infinite banking. And you got to use IUL. Whole life is trash. Use IUL. That's one category. The other category, I don't know which is worse, but the other category is get rich through whole life insurance. Get rich by buying cars and borrowing your own money. Like, both of those are incorrect in our opinion.
they're very clickbaity.
Very clickbaity. Like the one that I took notes on down here, like just how to use whole life insurance to get rich.
500,000 views probably or something.
500,000 views, right? And some of it makes sense in there, but a lot of it is misleading and flat out incorrect in the words that are used.
And let's face it, from an agent perspective, I'm trying to think through the types of leads that clickbaity stuff is going to result in. I don't imagine they're going to be the same types of leads that we get through our podcast, where education is prioritized, not, headlines saying get rich paying, buying cars, or get rich using life insurance, or whatever.
Yeah, I wouldn't even want to spend the time wading through those leads. I did that. You and I were talking before we hit record. I've got that YouTube video out there. It's got 220,000 views. It's a really good short 4.5 minute visual depiction of how this concept works and how whole life insurance works mechanically to support the infinite banking concept. But when I put my scheduling link out there on that YouTube channel, like that description, I would get a lot of meetings, and they were all garbage.
Right.
Didn't convert. I think I've maybe converted one or two over the years of people who found me on that website, on that YouTube channel, and contacted me.
Yeah.
Because they're mostly, people are clicking, they're trying to find, hey, what's the hot new thing? How can I do the hot new thing, whatever's popular right now? So, well, let's break it down. Let's first talk about the IUL crowd. So we've got a whole episode. I'll dig through it, or you can dig through it. The podcast links while I'm talking and find out what episode number that is, where we talk about why IUL is not the appropriate thing, product for the infinite banking concept. Now, when you watch any IUL video, you're probably going to see a lot of common themes. And pretty much all these videos say the exact same thing. And what you'll hear time after time after time is rate of return or internal rate of return. Like, you can make so much more rate of return on IUL than whole life insurance. So why in the world would you want to do whole life insurance? So it's all about rate of return. And Paul, what does Nelson say in the introduction to becoming your own banker? What is infinite banking not about?
This is not about investments of any kind. It's not about rates of return. It's about how one finances the needs of life.
Exactly. So these people
Something like that.
talk about infinite banking. They use IBC, they use the infinite banking concept, and then they talk IUL. If
They
you
can
know,
spell IBC, I guess.
they can spell
That's about it.
Yeah.
Yeah.
And they can spell IUL. So it just must be easier to spell than whole life. But they put those two things together, but it's very explicitly, they do not belong together. That's explicit in Nelson's writing, in everything that we promote, because that's what Nelson promoted. It is not the product you use for IBC. So you can't even, if somebody brings it up with IBC, they're not talking about the real IBC.
And I guess more simply, it also doesn't work for IBC, right? It's just, and I guess we'll probably dig into that a little bit of why, just to kind of rehash for people why it's not the appropriate tool to implement IBC.
Yeah.
And I'm looking for that episode, by the way. So you guys see me looking to the side. That's what I'm looking
Okay.
at.
It's probably like down there around 15 to 20 or something.
Okay, good.
Yeah.
That helps.
So really, these videos also fail to mention any risk whatsoever. So they'll promote all the good things. They'll cherry pick years like, oh, in 2017, all my clients were making 20 to 30% on their IUL policies in the cash value account, right? Well, one, most companies are going to cap you at probably 10 or 12%. The market could make 30 and you're only going to get 12. So then why wouldn't you just have your money in the market instead? If you're such a big believer in the market. But they never talk what happens when the market's down. Well, the floor is zero, great, but what'd you earn that year? Zero. You went a whole year without making anything. Now you got nothing to compound on.
Yeah, so there's this one particular company that has an indexed dividend option where you can go all in on that option, Dave, or you can do partial percentage of your overall dividend. You can basically take a little bit more risk for a little bit more maybe up to twice the upside.
And you're talking about a whole life insurance policy.
It's a whole life product, no doubt.
Option.
Right, where you have an option to index some or all or whatever you want of the dividend year, and you can change that year to year. So, and you get up to, whatever it was, 25% up and above the full dividend that everyone else that didn't elect that option got.
Yeah.
In a best case scenario, I think. But now if that index doesn't return anything, you don't get a dividend if you're 100% into that option. If you selected, I want all the risk for the dividend that year. There's a chance you could get nothing. So anyway,
and what you just mentioned there is the risk. So that's probably one of the biggest negatives to this, to IUL, to using that for infinite banking, is who's taking the risk in that scenario? You or the company?
Right.
You're taking the risk. Your premium for the insurance is going to the company. That's covering your insurance. The rest of that premium that you're putting in that side account for that cash value account, like, that's not buying insurance. That's buying cash value. Right. And they're taking the risk, or you're taking the risk as the policy owner on, is that money going to grow enough for me to afford the ever increasing cost of insurance?
Right. Well, no. I mean, when you're a younger person, yeah, maybe. But Dave, I've looked at several of these policies that people have sent me over the last couple of years, and this gentleman, I think he was 48 or 49 when he bought it. His agent I think we've talked about this in another episode, but his agent had died. By the way, we talked about Universal Life on episode 29. From August 29th, 2022.
All right.
Universal versus whole life for the purposes of IBC. But anyway, this guy's he'd owned the policy 8 years, 7 years, or whatever, and the cost of his insurance, which is one of the items on, one of the fees you're paying, is that cost of that annually renewing term insurance that Universal Life is built on. The cost of his insurance had gone from, $350 to $800, I think was roughly pretty close. And I pointed that out to him. And of course, he didn't notice, right? Mm-hmm. And I was like, I'm sorry to tell you this, but this policy is not going to provide you X amount of passive income for a lifetime, or it's not going to do any of that. Not even, I mean, it's not going to do any of that. And you hate to see it, but it's the truth.
Yeah. So I mean, we've had many clients who come to us. They have IUL or UL policies of some sort, and most of them decide to just, hey, I'm just going to cut my losses right now instead of trying to look at it as a sunk cost, a poor decision, and something you learn from.
Right, and we all have those. I mean, and it's. And that's okay. The point is to make execute some decisive action and get out of that mistake.
Yeah.
As soon as you can.
Yeah.
And I have a client right now that has an old Universal Life that his father bought for him, and that he's going to get rid of. And he came to that conclusion himself. I said, here's some resources, but
Yeah. So here's something else I noticed in some of these videos, the trend that these IUL promoters will talk about the benefits of life insurance and the stability of this life insurance product that's been around for hundreds of years, right? Went through the Great Depression, and banks had a lot of their money in life insurance and they didn't lose their money. And Americans who had their money in life insurance didn't lose their money. But they fail to mention that, that was whole life insurance. That was not IUL. IUL was created in the 80s by E.F. Hutton, which if somebody brags about that, it's like bragging about being a stockholder in Kmart. Like they're not around anymore. Like the company's gone, right? And why did they create it? Because what was happening in the 80s that was sexy?
There were super high interest rates.
Super high interest rates. And Americans finally had access to like the stock market. Everyday Americans.
Yeah.
Could put their money in the stock market. So all these people were getting, bombarded with marketing and put your money in the stock market, let it grow by 15%. So all these Americans were fleeing conservative, boring, guaranteed whole life insurance and putting their money in the stock market for that big rate of return, right? So what did this E.F. Hutton is like, how do I get these people back to whole life insurance? I know. I'll include the stock market in the life insurance policy.
Yep. I'll unbundle the savings component of a whole life product and create this side fund that's whatever. And there was Universal Life. It sounds great, like Universal Life, mysterious. It's kind of like the Federal Reserve Bank.
Yeah.
It's this mysterious thing. Oh, it's the government. It's the government money. Yeah. Something like that.
That nobody quite understands.
Right.
Yeah.
And so you said before we hit record, Dave, that Ralph Nader was involved in that stuff, and they were trying to simplify whole life. Well, what they did was, anytime the government and Wall Street and these other yahoos get involved in something, right, they screw it up. And I look at these universal life contracts, and they're not simple for the consumer. They're not simple for me as the agent. And
me neither. Yeah.
And we've studied these things, and I look at them, and I'm just like, of course, the law of unintended consequences, but they created a product that's terrible. And I don't want to disparage anyone that sells it. And you can go on, it's always, I'm a life insurance agent and IUL is the best thing ever. Yeah. Okay.
Let me tell you how difficult it is to get a life insurance license. Do you have 20 hours? Do you think
you have a functioning brain?
And can you answer a multiple choice test? You can become a life insurance agent.
Yeah. I've told people often that the bar of entry for many things that are regulated in the financial space, the real estate space, wherever, is the bar of entry is not super high.
Not at all.
And you can tell when you talk to some people that
Yeah.
they don't know in answer to a basic life insurance question, like what's controlled business, for example. I love asking that when they're like, did you retain anything?
What's guaranteed issue?
That's right.
Yeah. So anyway, let's recap this category and then move on to the next. But some of the biggest reasons not to use IUL, one, if you look at the fine print, the company can change that contract after it's already in place. If you look at a whole life insurance policy, the company cannot change. It's a unilateral contract. You, the policy owner, are the only person who can make any changes to that contract.
That's right. And you would have to, a lot of times, if it involves a significant change, you have to ask permission to change something. Like, hey, I want to turn this rider into maybe a 20-year rider from a 10-year rider, or I want to whatever. There's usually your involvement for sure, and your agent. But I like what you said before, on previous episodes, about the risk piece. Universal life violates the whole purpose of buying insurance, right?
Right.
You buy auto insurance, you're transferring risk. In case of a loss of the vehicle, someone crashes into you, they're uninsured or whatever. The lien holder requires you to have full, comprehensive and collision and liability and all this stuff. Well, Universal life violates that. You're retaining much of the risk. You think they illustrate very well, though, Dave, right? They look great on paper. Look at this. You're going to be able to take this much passive income starting at age 65 for whatever amount of years. And people are like, oh, without tax. Oh, this is great. Your premium is flexible. You don't have to pay the full premium. You can pay less premium.
Which probably means you won't pay the full premium.
That's right.
Human nature.
Human nature, right?
Yeah.
You can reduce the death benefit, which, if you know anything about whole life, and this is where our favorite financial entertainer always gets it wrong, along with all his flunkies in the comments that don't understand whole life insurance. Whole life insurance, the cash value is directly related to the death benefit. It is simply what the death benefit is worth right now. So this idea that when you die, Dave, that, the life insurance company keeps your cash. And you're right. Yeah. I can't watch those or read those comments because it just makes my head explode, because these poor people, they think they're the smartest people in the room. They think the guy that they're watching is the smartest guy in the room, and he's just spewing out the gospel, right?
Yeah.
It's the opposite. Like,
right.
He's ignorant on the subject, or he's lying.
And it's always the same thing. Yeah.
It's the same crap. He's selling a product, which is and I would say buy term and invest the difference. That's a product,
right?
That has become a product, right?
Yeah.
Anyway,
but one of the biggest risks you're taking with IUL, and why it's bad for the infinite banking concept,
cost of insurance,
is the rising cost of insurance. As you get older, the premium becomes more expensive. Now, theoretically, you're supposed to make so much money on your side cash account that they can draft directly from that account in your old age to cover your gigantic premium when you're close to mortality, right? Imagine paying, I don't know, $100,000 for a premium for a $300,000 death benefit. I mean, I think it gets stupid ridiculous.
Of course it does. It's cost prohibitive, and excuse me, like our friends say, nobody's writing that check.
Nobody's writing that check. And if you had all that cash value in that cash value account, why would you put all that money in there just to make it grow and accumulate so they could use it to pay the premium for you when you're old? What's the point of that?
Right.
Then you can't actually utilize it for anything else but paying the premium and hoping you don't outlive your cash value account. So it's like you compared it to auto insurance. It's like, hey, what if you got an auto insurance policy? But hey, when you have a wreck or a claim someday, there's no guarantee that insurance is going to actually pay out. It may not be there. You want to do this policy?
Why am I paying this premium?
Right.
That's the same question, folks, that you should ask your friends, your family members. I'm telling you, somebody you know has an IUL policy out there in their drawer, and they don't know where it is. They don't know what it's worth. They have no idea how it works. They think they have permanent life insurance.
Yeah.
And while it's characterized as such somehow. It is not.
And they probably can't even get a hold of the same agent that sold it to him.
Oh, I have no doubt that guy's not working in the industry anymore. He did it for a couple of years and then moved on.
A couple of years and moved on to the next
whatever, the next shiny object.
Else. Yeah. Ripping people off with something else.
But again, like, know what you have. Know that there's risk. There's a rising cost of insurance. Again, like Dave said, that's the biggest thing. It can't be overcome. You're going to get older every year. The company has to charge an appropriate premium to keep that amount of death benefit in force.
Yep.
And anyway, and again, I think the thing that I always ask people when this subject occasionally comes up is, do you want a product that gets less efficient and more expensive with time, or do you want a product that gets better with age and cheaper?
Yeah.
Well,
and is guaranteed to last.
That's the only question that needs to be answered.
Yeah.
Right?
Guaranteed to last one day longer than you.
That's right.
Yeah. So, okay, well, let's move on. We beat that dead horse.
Yeah. He's dead.
Yeah. He ain't coming back. So how about this one? Use whole life insurance and get rich. Buy cars and get rich. Do nothing else but buy cars with your whole life insurance, and you'll get rich. Like, you're not going to get rich. Let's just dispel that rumor right there. Simply simply funding and utilizing whole life insurance will not make you rich.
That's right. That's right. It is a great product. My favorite financial product. We should all be paying high premium relative to our income wherever we're at for as long as we possibly can, Dave, for sure. But again, this is about IBC, right? We should be in two businesses. Whatever we do to earn a living, and the banking business. So the IBC side this is my banking business. So I think I've said it before, you can lose less money buying a car, but buying cars, and again, we're not talking about a rare Ferrari or Bugatti or Koenigsegg, whatever. We're not talking about these McLarens or whatever, these collectibles. We're talking about your run-of-the-mill Honda Civic, Honda Accord, whatever, Toyota Camry. Buying cars is a losing proposition. It's just it's a tool, right? And it wears out. It's a mechanical thing. It's kind of like, capital. It's like equipment. Equipment wears out, needs to be replaced, needs to be serviced, needs to have an overhaul done on it, whatever. So it's the same thing. But as Nelson demonstrates in the book, you can recapture interest that we would otherwise bleed by paying cash, a lost opportunity cost, or by financing it through a third party. We can recapture that interest by capitalizing whole life insurance policies to fund the needs of life, right? So
yeah.
Anyway,
so when you're out there, you see these clickbait videos or the articles. Some of the things are going to tip you off that this person is being misleading, or they just don't understand this. Some of the things, if they ever call it an investment, they'll say, I watched one video about how to get rich using whole life insurance, and he said 401ks are an inferior investment to whole life insurance. Basically, now you're putting life insurance and investing in the same. You're trying to compare those two side by side. You can't. It's not an investment. So if anybody infers or explicitly states that it is, stop listening to them, because you're just going to get more confused.
Run away.
Yep. They don't know what they're talking about.
Yeah. You're not making a contribution, right, Dave, to a 401k. You're paying premium to the life insurance company. Those dollars are no longer yours.
Yeah.
They're the life insurance companies, aren't they?
Yeah. But that cash value is guaranteed to be there. What are investments involved? They involve risk. What is risk? Probability of loss.
Yep.
So there you go. They're two different things.
That's right.
What about people who say borrow from yourself and get rich?
Yep. Words matter.
Yeah.
And this comes up a lot, though. And especially early on with folks when they're like, well, if I take money, and we like to use precise language, don't we? Because one little word can matter. Like, I'm borrowing from myself, or I'm taking money out of my life insurance, or from my life insurance, right? Mm-hmm. Well, no, we're borrowing money from the life insurance company when we take a policy loan. They're using the cash value or the present value of the death benefit, so the death benefit in other words, as the collateral for that loan. So they're giving me a loan, they're guaranteeing the underlying collateral, which is the death benefit, right? So it's a great borrowing position, and it's a great, and we've talked about this again, it's a great loan for them to make because they've already baked in the cost of that loan into the design and the pricing of the whole life product. So, and then people ask, well, let's say I've got $1 million of death benefit, I have a $100,000 policy loan out, and I drop dead the next day. Well, the life insurance company is going to pay off that loan, and then your beneficiary would get the net death benefit, which would be $900,000, maybe minus that 1 day of interest.
Yeah, because you spent the equity.
That's right.
You borrowed the equity.
It's like when I sell my house, do I get the?
Yeah.
What do I get when I sell the house? Well, I get my equity plus, I sold the house for.
You get market value,
right?
You don't get market value and the equity,
right? It's just
wouldn't that be a big deal? Yeah,
right.
So,
and I always tell people that when the entertainer says they keep your cash value and you only get the death benefit, it's the same thing as the house example we just talked about. So it would be ridiculous if they gave you everything back. Oh, here's your $3 million death benefit plus the $700,000 over the last 15 years that you paid in premium.
Yeah. Yeah, right.
That doesn't make any sense.
Not at all.
It's super annoying.
Yeah. Now, some other things that you'll hear, and these should tip you off that, okay, I don't think this person is qualified to teach me about the infinite banking concept. When they talk about, if they just talk about tax-free growth, growth. Life insurance is not tax-free growth. It's tax-deferred growth.
Yes.
But you can access it tax-free through the loan feature, right?
Correct.
Which is what IBC is all about.
Yep.
Or if they say, hey, my policy, it guarantees me, it's got a guaranteed rate of 3%, so I'm guaranteed to make 3% per year. No, you're not. That's not how that works. That's a piece of the equation, how they calculate and reverse engineer the entire thing.
Correct.
That doesn't mean you're getting 3% per year guaranteed.
You see that a lot out there, folks.
Yeah.
On the right side of the YouTube stuff, like, well, my policy is earning a guaranteed 4%, and God bless these people. Some of them I think are definitely doing the right thing and trying to do the right thing, but again, we need to be precise. We need to be precise in our language because it's deceiving to say, yep, this life insurance contract is guaranteed to earn 4.5% or 4% or 3.75 because there's this little verbiage in the contract that says the basis of values is 4% or 3% or whatever. And again, as Dave just said, that's not what that number means.
Yeah, and we don't want to get into the nitty-gritty details on that. All you need to know is if somebody's saying that, they're not educated well enough to inform you about infinite banking. Move on. Find somebody else. I was watching one. Go ahead.
No, you go.
I was watching one video, and the guy said, you can borrow from the life insurance company, and the interest rates are typically much lower than the banks. Well, that's actually the case right now. But for the last 15 or 20 years, that has not been the case at all.
Right.
So
that's right.
Somebody who's, again, trying to make it sound like more than what it is.
Yeah, exactly. And that's what I was going to say is, listen, IBC, the process is better than sliced Italian bread. Oh, well, maybe not. I mean, Italian bread's pretty good, but you get my point. It's great. Dividend paying whole life insurance is also a great product. And then you marry the two together and it's all right. Now it's better than Italian bread.
Yeah. It's like focaccia bread and olive oil.
Yeah.
Right? Extra virgin olive oil.
That's right.
Yeah.
But one thing I think that we do and our friends do very well, we're not trying to make any of this better than it actually is.
Right.
All right. I have taken money that I have already been saving as I've made more money with pay raises or being more productive or whatever. I've paid more premium, which gives me more access to cash value via the loan feature. there's a capitalization phase where I'm upside down for the first 10 years, let's say, in a policy, 7 years, 8, whatever it is. I don't care. I literally don't think about any of these things, but
Right.
a lot of people do apparently. And that's fine. But again, this is a long-term strategy. You're not going to get rich quickly doing this. However, you will create generational wealth. You will have more options compared to your peers when you can no longer or want to or can't or won't labor for a wage. I can't help you see that, Dave, but that's all true.
It's like anything else. Just think about the last big goal you accomplished, or the thing that you're most proud of over the course of your lifetime. You probably have certain events that you were very proud of. Maybe winning a state championship in high school, or graduating from whatever college, or getting that big job. Did any of that come without a lot of sacrifice building up to that?
Right.
Of course
You
not.
didn't fall into it.
No, because if it didn't require any sacrifice, it wouldn't even register in your memory.
Right.
Who cares?
Right.
Right? It's not a big deal. This requires sacrifice, just like anything great that you'll ever accomplish in life is going to require sacrifice. But the great thing is, this is guaranteed to succeed.
Yeah,
Like,
very well said.
it's pretty easy to sacrifice when you know it's going to succeed, right?
Yeah. And it's going to succeed kind of like many times over, regardless of what you do, except just pay your premium as illustrated, folks.
Yeah.
That's
And it's
the
going to
only thing
succeed.
you got to do.
It's going to be great for you, but it's even going to be even greater for your beneficiaries.
That's right. So let's talk about something real quick, just to give a quick golden nugget to somebody. Even
All right,
though,
real quick, we'll wrap it up.
yeah,
Go
many
ahead.
people already know this, especially our clients, because they can look at their contract or look at their illustration and just see this for their own eyes. But if you're not our client, go look at your whole life contract. Look at age 100 or age 121, depending on how old your contract is. Now age 121 for policies issued in the last several years at least. But my original whole life, they endowed at age 100. Notice that the cash value and the guaranteed side, non-guaranteed side, and the death benefit are the same number, right? So again, do you want to have, Dave, a large death benefit, meaning as much as you could possibly get past the underwriters through a lifetime of premium, or do you want to have like this, well, you can reduce your death benefit IUL kind of attitude?
So you're saying the more death benefit I have, the more cash value I'm going to have.
Yeah, no question.
Okay. Then I want more.
Right.
Yeah.
And if at that number, if the cash value you'll have access to will be many times over the premium you've paid, are you really sacrificing anything other than the startup costs in the early year?
Yeah. The short term, lack of liquidity to go spend on, whatever random things you want to spend on. So,
Yeah. And that's
no,
part of
you're
the
not.
noise that I see out there in the wide world, is just everyone wants this like instant liquidity, cash on cash in the policy in year 4, year 3.
We want it today. We want it yesterday.
and
Yeah.
and they won't budge in that. And God bless them. Hopefully it works out great.
And that's fine. They're not our clients anyway.
Nope.
So,
Nope.
All right. So hopefully that hit home for some of you, and those of you researching infinite banking and stumbling upon this podcast. Just some things to look for when you're out there researching, so you know who to avoid and why to avoid. So
Yeah, that's right.
there you go. Well, all right. Have a great week, everybody. Have a good week, Paul. And I'm sure we'll talk again before you leave for Italy. But
Yeah. Oh yeah, for sure.
yeah.
We talk
All
like
right.
every day, don't we?
Pretty much, at least text
Yeah.
or send reels or memes to each other.
Yeah. There's some good ones lately too.
Yeah.
There's some just creative, funny people out there, man. That
There
just
are.
they
Thank
have
God for
my
that,
sense of
'cause-
humor. It's just,
Yeah, I need that dopamine hit when I'm having lunch every day. It's like the only
Yes.
time I'm searching for stuff. I
Yep.
need a break. Give me 20
Yeah.
minutes.
Well, I'll keep that in mind from now on. If I come across something during lunch, I'll make sure I blast it to you in that moment so that
Yeah,
that you've got it.
cool. All right, man. We'll talk to you next week. And until
buddy.
then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.